Hello my dear students, and welcome to these mini-series of lectures in macroeconomics. Tonight we're going to talk about certain metrics that are used in order to measure the size of an economy. What you read in typically newspapers, one very well-renowned metric is gross domestic product. Lots of references to gross domestic product. This is typically all the production, all the services and products that are actually produced in one country in 1 year, and those goods have to be final goods, right? So second-hand goods would not count for gross domestic product. But there are other metrics that economists typically use to measure the size of an economy, and for example, we can think of gross national product. Gross national product. You see the difference is the letter in the middle. This is domestic, this is national, and I will explain in a second why that's the case. Another metric that is typically used is national income. National income. Okay, what we're trying to understand tonight is the relationship between these variables. And so we'll try to go from national income to GNP, and then finally to GDP. Okay? So let's start with national income. So national income, which is fairly straightforward, national income, is in essence all the compensation to the inputs in one particular economy. So we can think of wages plus profits plus interest plus rent. That's the way we define national income. Okay, but we left something out. For example, there are indirect business taxes. So if we add to national income, and we can think of sales taxes, for example. If we have national income here, plus indirect business taxes, what we obtain is the net national product. So net of what? Well, typically when we use the word net, that means what net of depreciation. Since we have to depreciate our capital every year, right? So if we want this measure to be gross, so that includes also depreciation, of course we just need to add depreciation to the net national product. So let's use an acronym, net national product, NNP, plus depreciation, and we'll obtain finally GNP, gross national product. So we went from national income to GNP. Now we want to go from GNP to GDP. Before we do that, what's the difference really between GNP and GDP? Okay, the main difference is you can see that the word in the middle, national versus domestic. Really the difference is that we measure for national, we look at the nationality, right, of those inputs, the owners of those assets. And for example, we would not count, if we're talking about measuring the size of the US economy, if there was a plant in the United States that it belongs to Toyota, for example, which is a Japanese company, the economic activity of that plant would not count for GNP, but would still count for GDP since that activity takes place within the national borders of the United States of America. Okay? So that is really the main difference between GNP and GDP. And so now we can try to go from GNP to GDP very simply. So we can say that GNP minus the income, right, minus the income from other countries, plus the income to other countries is equal to GDP, gross domestic product, because in this way we measure simply the economic activity that took place domestically within the borders of the country. So in essence, we start from G and P, then we subtract the income from the other countries. For example, a US plant or a plant in China or Japan that belongs to an American company. And we add back that particular plant, for example, that belongs to Toyota, since now we want to account for it, since the plant is within the borders of the United States of America. So once again, basically we went from national income to GNP and finally to GDP. And we just need to keep in mind that all these metrics are normally used to measure the size of an economy. All right, thank you very much, and I will see you for the next lecture. Thank you.